Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Okay. And I'm going to share my screen while I'm doing it. If anybody is joining us for the first time, Will and I, we do this show in the mornings every day to try to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we provide a link to Zoom on the live chat on YouTube. If you click on that link, it takes you over to Zoom. Once you're in Zoom, there's a button on the bottom, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, everybody can hear you. You could ask your question live, direct, navigate us to what you're looking at. If you prefer to type in your question, you could also type that question into the live chat on YouTube. Will's watching it. He'll read the questions back to me. While we're waiting for people to come in and put in questions, we'll start out taking a look at the pre-market report to get some insights what's going on in the pre-market hours. If questions don't come in or we don't have any questions today, I'll just navigate to a different part of the website. We'll talk about other insights, or I'll default to some questions that I get either through the email or chats. Okay, so let's start out with the pre-market report. These are stocks trading in pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 72 stocks made our percentage gainers list, 355 on the decliners list. So from this perspective, right now, we're looking like we're setting up for a more bearish bias at the open. And some of that right now has to do with the banking sector here, Credit Suisse, here down 28%. And that's getting the markets worried. Yesterday, we had a big up day. There's a rebound. Actually, I'm going to show you guys yesterday some of the big orders coming in at the end of the day, if we have time for it. But now we're reversing that, getting some negative news in the morning. If you look at this list, though, you'll see that there are small cap stocks and there are ETFs, leverage products. Could be a preferred stock. It could be even a right. So anything that trades on or is listed on the major U.S. exchange, and if it's trading in the pre-market hours and meets our thresholds, it could make this list. And we want to narrow down this list maybe to a smaller group of stocks to get a little bit more focused insights. And you could do that by using the filters here above. So this one in ETF, I'm going to drop it down and you get a list of ETFs to choose from. There are some sector ETFs in there, broad-based ETFs, and the top one, SPY, that's S&P 500 ETF. So let's select that. And the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see so far one made our percentage gainers list, 102 in the decliners. So this, again, is looking like a bearish bias at the open. Lots of bank stocks, financial companies are in here right now, going lower. And we did comment a little bit on these financial stocks like banks and even insurance companies. And the hardest thing they're very difficult to put a valuation. You'll see a lot of them trade really near book value. Some of them are going to be trading at a discount to book value. And that's because they are in the business of risk, right? It's not like producing an iPhone or gadget or something where you produce it, then you sell it, and you produce more and you sell it, but they're carrying risk on their books, which is very hard to shock, to really know what's going on, because there are too many inner relationships going on in the financial system that even if something seems today like it's hedged off, there's low risk, there's not much going on, and then all of a sudden something unexpected happens. And what these banks, what we've seen in 2008 and kind of what we're seeing right now, is that their tail risk, right, is much higher than a lot of other companies. Like, look, even like FTX, how fast did it collapse? It took FTX was almost like a traditional financial, it had lots of deposits in there, but what happened was people started withdrawing the deposits and really quickly, and it all unraveled, right? Same thing with the SVB bank. People keep looking at it and saying they had duration risk, right? So they did have they had duration risk, but they were holding really US government bonds. So on the surface, probably up to the point, it failed really quickly. Up to that point, anybody looking at it thought it was that the balance sheet was fine. So I think that maybe the market is starting to look at these and saying that any of these for shareholders, there's tail risk in there that maybe is not fully priced in or fully understood, where the collapse of them, it's not gradual, it could be very, very quick, right? Like, you don't see, usually companies that are doing bad or failing takes time, they lose customers, they let go of, they cut down expenses, they let go of employees, they start doing things. But the collapse of a financial institution can be very quick, and probably the bigger they are, in my opinion, I think that those are even riskier, because there's so much stuff going on there that no regulator could come in and tell you, they're not reading every contract or every clause in each contract and able to run, different types of shocks, because there are too many variables to run and anticipate and model the human behavior of those changes in variables. So even like something like JP Morgan, I think that everybody's like running to. How do we know it's safe? Nobody knows, right? No regulator knows what's going on. By the way, in the 2008 crisis, they had the Federal Reserve try to figure out these risks that they have on the book with credit default swap and stuff. They said we had PhDs with the highest level of education go in there, and nobody understood what they had on. Nobody could explain the risks of what these banks were holding. And those are maybe some of the risks in these financial institutions that as a shareholder, you got to be aware of. Because even if what we've seen is now they did bail out the depositors, but the shareholders got wiped out in like 2 days, right?
And the bond holders, I think.
Right, and the bond holder, right? So the investors themselves are not getting bailed out in these situations. Like here we're going to see how Credit Suisse plays out. But now that one is showing stress where. Let me come back to. Now Credit Suisse, you could see down 27%. and we'll see how that plays out. But what are all the interdependencies? What happens if Credit Suisse does have to close and liquidate or whatever? Nobody knows how that spills over. So those are the issues right now.
Yeah, and what is the bank? How is the banking system going to have to change to this new, implicit guarantee to all accounts, right?
What's going on right now is that the Fed is trying to act really quickly to prevent contagion risk, right? So it's because the banking system has a contagion risk that other industries don't have, right? So for example, the Meta could do really bad, right? Something could go wrong, let's say, but it doesn't spread to the housing market and all these other that like the banking system does, right? It could be it could be contained. It could spread out to other businesses that have relationships with Meta, but it's not as quickly as like where these banks have their tentacles touch everything, right? There are too many interconnections in there. So what's happening is like that the Federal Reserve is acting very quickly, trying to prevent that from happening, that it spreads.
In the meantime, what happens to inflation?
Right, and that's the questions that we want to ask, is that trying to prevent a banking crisis at the same time as you have inflation. It looks like we're keep walking closer and closer to a worst case scenario, in my opinion, which is very hard to navigate out of, is a stagflation. And we didn't have stagflation for a long time. That at this point, the models don't even think that is a probability or a high probability of happening, right? They think like either we're going to go into a recession and then stimulate out of it, right? Or that inflation is going to just come down and then we're going to start lowering rates. Like those are the highest probability bets right now going on. But stagflation is the worst because you cannot easily navigate out of it, right? You can't just drop interest rates and increase government spending to inflate because you already have inflation. You're gonna make that problem worse. And if the economy's already dropping on its own, right? If it's dropping on its own and you can't deflate, right? So there are no tools that I know of that effectively can get you out of stagflation. That's like a trap, right? It's a trap.
How did Japan get out of it?
Well, they have deflation, right? They have a problem with.
Well, from the last decade, wasn't that stagflation in Japan, like the 90s through 2000s?
I don't think so. I don't think they had. Did they have inflation at that point? Because right now I know that they have like.
It says, I just looked, from 1991 to 2001, Japan experienced a period of economic stagnation and price deflation known as Japan's lost decade. But while the Japanese economy outgrew this period, it did so at a much lower pace than other industrialized nations.
But so when you're saying price, how did you say price deflation, right? What you just read.
It says what has Japan been in stagflation? And it says from 91 through 2001, Japan experienced a period of economic stagnation and price deflation.
So stagnation, price deflation, right? I'm talking about where inflation's moving up, prices are moving up, and economic activity is going down. So it's different. They didn't experience price inflation like we are now.
Yes, no, they did not.
So stagnation and stagflation. Okay, so what I'm talking about is stagflation, inflation with an economy going down. That that I've seen has very effective tools. Then you got to pick one. What's more important, right? If your price stability is more important, then that means you're going to have to send the economy down even deeper than it is already to control that inflation. So they have different words for, I think what you read was how did you call it? It's not stagflation, it's stagnation.
Maybe stagnation.
Right. So what I'm referring to is stagflation, because we have 6% inflation still. And, is the economy going to, what is going to happen if we're going to see these problems? We're not there right now, right? Because we still have economic growth. Anyway, so one of the things, I don't know, do we have any questions?
Rob says criticism. No, Rob was just mentioning something about Credit Suisse. He says it's regulated by both foreign and U.S. regulations. The Saudi royals are one of the biggest investors, but they turned down a request to invest more money. I guess that's one of the reasons.
Yeah, so Credit Suisse, right. And I think the reason is because they don't want to own more than 10% of the equity, because then once you go over 10%, you have other regulatory requirements that they said that they hit their max ownership in Credit Suisse. And probably maybe they don't even believe, that they want to sink any more money into it as well. I don't think that was the only reason, but that was one of the reasons that they said that they hit their glass ceiling, the most that they own as a shareholder without meeting, going over to meet new regulatory requirements. One of the things while we're on here is what we could discuss is that, we look at the pre-market and, what is different in a pre-market than in regular trading hours, right? What kind of insights can we get in a pre-market? What's going on and why is it different than regular trading hours? And when we look at the market, if we chop it up in trading sessions, we have pre-market, we have an opening cross, an opening auction, then we have regular trading hours, we have a closing cross, and we have after hours trading. And within those sessions, there are differences, important differences. And because they're important differences, you could kind of slice out and get different insights based on the trading activities. So let's take pre-market right now, pre-market and regular trading hours differences. And in the pre-market, it's a different trader cohort than in the regular trading hours. So we kind of get insights into a certain trader, certain trading style, trader cohort that it exists in the regular trading hours, but they're lumped into other ones. And that's in what I call as an active trader versus passive. And when you have regular trading hours, you have everybody is participating: active traders, passive traders, market makers with obligations. You've got people employing different strategies that are pegged to other things. But in a pre-market, you don't see that. So, for example, mutual funds are not trading in the pre-market hours, right? They're not putting in their big VWAP orders. So VWAP order, for example, it's more passive. They hand it over to Goldman Sachs, and they're trying to buy a certain amount of shares over the course of the day, and they peg it to the day's VWAP. That wouldn't include the pre-market, okay? Because they need the day's VWAP. They're not trading in the pre-market hours where it's more illiquid. They're not actively pushing in those orders. So they're not in there right now. So we kind of get a glimpse of, well, if they're not in there, what are these active traders doing? Okay. And there's other passive tradings, like, people are doing it through pension funds, IRAs, whatever. They're not actively out there creating, accounts to be able to trade in pre-market hours in, in less liquid markets and so forth. So these would be traders that are, looking at data or information and either repricing it based on fundamentals, any kind of news. So they have their models to reprice it. It could be somebody hedging a position. So options markets are not open yet, so they're not hedging active option trades, but they can be re-hedging their position, right? So you still have a position, and you may or may not want to hedge some of that off. You have technical traders perhaps trading in there. You also have people anticipating the order flow the rest of the day, maybe the opening or so forth. They're in there. So we're slicing out that there are certain players in this pre-market session that exist, and then there's certain large players in this market that are not going to be actively trading in the pre-market. So we're kind of getting a glimpse of what a certain trader cohort is doing. Okay, does that make sense? Hopefully to people. And that's how we're seeing, where are they pricing it without everybody else getting in there? Where are they pricing it? Where do they think, the value of this stock should be? Because they're really taking risk trading in those illiquid pre-market hours where the VWAPs didn't come in. The specialist books are not, they're not all active, where, the market maker obligations are not in there. So they're kind of coming in there right away, trying to express their opinion of the stock fair value. And as we go down, so you can see here, Credit Suisse, right? They're down 26.7% in the pre-market hours. We see this is the VWAP price, $1.93. So right now it's trading even below that. And we also get, I believe, hold on a second. 26 million shares, the volume. So it's pretty heavily traded right now. And again, when things open up, you're going to get different trader cohorts going in there, and this price will start reflecting their views as well. As we go down here, I have a couple minutes left, so I'm just going to kind of go through this. Will, if you do have questions, those stop. Okay. As we go down here, we have a little bit more data on the volume breakdown in the pre-market hours. And we chop this up into three sections, right? So here we have these VWAP bars. And the VWAP bars, some people call them anchored VWAP, but they're very helpful to kind of visualize where the concentration of trading is, or centered around, which prices, and how far apart are these big concentrations of trades from each other. So you could see if there is a liquidity gaps, right? Like liquidity holes, and how far apart. So just from here to here, obviously this is just pre-market. It's not the whole day, but we could just see here, kind of skip down to here. There's two large ones. So the idea is, how far apart is the real liquidity, once it busts through a certain, price point, where's the next level where there's a lot more liquidity, right? Because if we saw the same exact liquidity on every single penny, every single half dollar, then these bars would all be equal, right? But we see that there are these liquidity gaps or holes, like it could be like black hole where you're like, whoa, what happened? A lot traded here, and then all of a sudden we went down with not a lot trading in between. So this gives us an idea of like the volatility and where, there was a concentration of trading where there was a more meeting of the minds, and how far apart are they widening out? Are they narrow? The wider they are, the less liquid there is, the less certainty there is in pricing. Over here, we draw the same bars, except now we divide them up with who's participating, what kind of traders participating at these prices. And we divide them up into small retail traders, proficient traders, professional or institutional, based on the order size of the execution. Okay, so we go in there and we estimate that this is the size of the order that was executed. We measure how the distances apart of each order to get an estimate. It wasn't most likely initiated by a retail trader, professional, institution. So you could see here that right now we do have a lot of retail traders, a lot of higher professional traders moving some stock, and then the institutional trades are like the very big trades. So they're make up smaller proportions so far. All right, and in the pre-market, you would probably see less of those bigger institutions unless they could find crosses somewhere. Another way to slice it is by the trading venue. So our markets are fragmented, okay, by trading venue, and we have like these private operators of exchanges, and then we have public exchanges. Okay, so the lit exchanges are public exchanges. Anybody could access them. So NASDAQ, NYSE, those are public exchanges. So you have a broker, you could send an order into those exchanges. Dark pools, those are private exchanges that you would need to become a member, get approved, or your broker is approved to access them. Okay. And those dark pools trade differently. They have different rules in place. They don't display bids and offers, but they do match orders up on their book, but they do have rules around the trading prices, and there's some other rules in there of how they could match it up, and then once they do match up, it becomes a trade, and then they report it on the public tape. Okay, and the difference would be that the lit exchanges have certain types of traders that dark pools would not allow, like a high frequency trader or a trader that can react to new information very quickly. So those are called like, where they take advantage of slower markets, and they could, if they sense that something should be priced higher or lower, they'll take the liquidity really quickly before somebody else does and reprice it. And the dark pool operators, they keep those types of traders out of there because they don't want their liquidity providers getting harmed by adverse selection, right? So they don't want to just stick their neck out to their traders because they want a more fair system of people exchanging, not getting hurt by providing liquidity because somebody else has plugged into information and has the ability to quickly take liquidity that's too slow to react to that information. All right, so all these things that are happening, it's important to understand. And so then when you look at the volumes, when you look at the potential positions, you kind of understand who's doing what, where it's happening, the magnitude,
Hey, Deke, we did have a new Helen's on. She's new to the Chameleon community. She was asking about, she'd like to see this information for Schwab, SCHW.
Yeah, well, we're right up at 9:30.
All right, maybe we'll look at it tomorrow.
So yeah, maybe we'll take a look at it tomorrow, but I'm gonna let everybody go here.
All right,
to
awesome.
9:30, but yep. So everyone, thank you for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Remember, thumbs up and subscribe below, everyone. Thanks so much. Great job, D. Have a great day.